Welcome, everyone. I'm Tim Nyland, co-CIO at Synergy Asset Management. Today, we're covering the key considerations advisors need to understand about private credit. This is a 30-minute educational session, not a sales pitch. Private credit is a compelling asset class, but informed allocation requires understanding the risks. Let's start with a bit about my background. I have 32 years experience across equity valuation, asset allocation, market strategy, and institutional portfolio management. This isn't just a credit perspective, it's a full capital markets perspective. As the co-CIO at Synergy Asset Management, I work alongside the founder and CIO, Joe Mass, overseeing investment strategy, research, and portfolio management across all strategies. In 2022, I joined Pacific Point Advisors as a director of research and portfolio manager, where I helped develop proprietary separately managed account strategies. Through Synergy, as outsourced CIO, I continue to support Pacific Point Advisors, providing ongoing guidance on proprietary stable earning strategies that I helped develop during my time with the firm. Prior to working in the RIA space, I led the $500 million a year portfolio management division at Thomson Reuters as global head of portfolio management. Businesses included Baseline, Thomson One, DataStream, and Vestec, and I also contributed to the early development of the Icon platform. I was an equity strategist and managing director of Zacks Investment Research and designed proprietary research and valuation systems at StockVal, ADP, Bridge Information Systems, and Zacks, including the G model, Zacks equity valuation model, and the earnings certain model portfolios. The most unique part of my background is that over the past 32 years, I've had the privilege of consulting with thousands of asset managers and advisors globally. This experience informs the perspective we're sharing today. Regarding credit and private credit specifically, we've seen credit cycles come and go, and this one, like all other, has unique characteristics. Before we dive in, let's frame the Synergy Asset Management perspective on private credit. Private credit remains compelling. This presentation is about being informed, not fearful. We're not saying to avoid private credit, but we are saying that advisors need to understand the nuances that the sales process often glosses over. The goal is to equip you to ask better questions and to make more informed allocation decisions. Let's look at what sparked the current wave of concern in private credit. In late 2025, headlines created panic, but it's really the context that matters. First Brands and Tricolor bankruptcies triggered sector-wide anxiety. Jamie Dimon fueled the fear with the cockroach warning that amplified the hidden losses across private credit portfolios. I should say the fear of hidden losses across private credit portfolios. But senior secured direct lending losses rates remained within the historical norms over that time period. The takeaway here is the headlines reflect sentiment, not the fundamentals, but it's the sentiment that actually drove the redemptions. Here's the irony about those two headline events. The key point is that First Brands and Tricolor were alleged fraud cases. They weren't private credit failures. Executives were federally indicted for double and triple pledging collateral. Tricolor's primary lenders were JP Morgan, Fifth Third Bank, and Barclays, and these are traditional banks, not private credit. Cambridge Associates confirmed these were company-specific frauds, not systematic issues related to private credit. The media used private credit as a catch-all, misleading advisors. The takeaway here is that when clients bring up these names, feel free to correct the narrative. The following slide provides a nice illustration of the main types of private credit funds. Direct lending is the largest strategy, senior secured floating rate, mid-market. Mezzanine offers higher yields but greater risk. Distressed debt is opportunistic, buying at a discount and restructuring. There are a bunch of new categories, always emerging. AI, infrastructure lending, NAV lending, specialty finance. The key takeaway here is that there are lots of types of private credit funds. And when you couple it with the different structures within the fund types, it can really feel like the wild, wild west. So let's take a look at how these private credit funds are actually structured. Absolutely love this slide. And I do want to take just a minute to mention that you don't need to take notes here. This is probably one of the best slides in the deck. It outlines the private credit fund structures, and you can feel free to email us. We're more than happy to get this deck out to you. Feel free to use it as a resource for your own questions and your own decision making. The key here when you're looking at this slide is that as you move down this table, you're going to want to notice that three things happen simultaneously, and you really need to understand all three as an advisor. So as you move from the top to the bottom in terms of the structure, you'll notice that the liquidity declines, and you can see that liquidity column there. Everything's color coded. You'll also notice that alongside that, if you read the liquidity mechanisms, which I'm not going to read for you, you can request the slide deck. You'll notice that they become more complex as you go down, right? So simple exchange sales give way to, gated redemptions, cap tender offers, and eventually, no liquidity mechanism whatsoever. When you get down to the closed end side, it's just secondary market sales at a discount. In the next column, you'll see regulation. And as you go down, obviously the regulation is going to get more relaxed, right? Publicly traded BDCs sit under full SEC and 1940 Act oversight. But by the time you reach the closed-end drawdown funds, you're in exempt structures with minimal regulatory guardrails at all. The next column you'll see is investor access, and you'll note that as you go down, investor access becomes more exclusive, right? So anyone with a brokerage account can buy a public BDC, right? Business development company. But at the bottom of the list, you'll see that you need to be a qualified purchaser or have qualified purchaser status. So these are really institutional only vehicles for like pensions, endowments, and sovereign wealth funds, among others. So the takeaway here is that there's a clear trade-off, and this table that I put together for you really does a nice job of outlining the trade-offs, right? So it's less liquidity, more complexity, less regulation, and narrower investor access. So make sure your clients understand what they're giving up at each step down this table. This next slide is all about the framework, and this slide illustrates the three lenses that we use at Synergy Asset Management for evaluating private credit risk. Okay, so the very first lens at the very top of the triangle there is technology concentration. And again, these lenses they will evolve over time, right? Right now we're seeing, AI disruption and a lot of software we call SaaS, software as a service, borrower exposure. In lens two, you can see that we've got liquidity and structural risk, right? Gates, redemption caps, fund structure mismatch. You guys have all seen it. You guys have been on social media. I mean, the social media sphere is just absolutely flooded with all of the issues surrounding gates and redemption caps right now, and we're going to touch on that in just a minute. But lens three is the valuation and transparency, and this is the one that probably doesn't get enough focus. I think everybody's really focused on the liquidity. When everybody's trying to hit the exit doors at once, all they want is their money back. But lens three is super critical, and we'll spend some time on that as well. So it's really the mark-to-market bias and the reporting opacity there. Everything that follows in this presentation maps to one of these three lenses. So the very first thing I want to do, though, is I want to walk through 5 real-world examples of how our three lenses for evaluating private credit risk discipline at Synergy Asset Management can help identify and quantify private credit risk. So these next 5 slides will be super important. This first slide is one that I found floating around on social media. It came from the Lead Lag report. I guess it's a newsletter, and it did a nice job of outlining how tech concentration becomes a liquidity crisis. And so in terms of technology exposure, this is what we do. We look at the risk chain. Private equity loads up software companies with debt. The AI disrupts the SaaS or the software revenue. In turn, loan values fall, loan to value ratio deteriorates, and then redemption queues form. JP Morgan then, marked down software loans. Blue Owl and Blackstone's are obviously facing redemption queues. And then Goldman estimates that 80% of direct lending doesn't allow easy redemptions. So here, the key takeaway is to, as advisors and as asset managers, we always want to assess the software concentration before recommending any direct lending fund. This software concentration, this tech concentration is real, and it's not transparent. And I'll show you what that looks like here on the next slide. This is a slide that is kind of dear to my heart when Meta and Blue Owl announced this, and after Meta reported the quarter after, I looked at the balance sheet and found that obviously this was another form of off-balance sheet financing, which adds a whole nother layer of risk. But in this case, this is the actual structure of the Meta and Blue Owl AI data center lending. And this really kind of shows you the scale of what's going on. This is called Project Beignet, and it illustrates the complexity and counterparty concentration and really the novel risks embedded in AI infrastructure credit. And for those of you that don't know what a beignet is, it's actually I think it's like a French pastry or a donut. But yeah, if you go to New Orleans, you'll run into a ton of them. Interestingly enough, that's where this data center resides, is in Louisiana. So we'll talk about that in the structure here. Blue Owl funds hold 100% of Beignet Investor LLC, which in turn issued $27.3 billion of Richland Parish, Louisiana data center infrastructure notes. That's what that acronym RPLDCI stands for. So effectively, Meta owns 20% of the data center campus via this Iris Crossing LLC. So obviously the risk here is that we have single customer dependency, right? If Meta reduces its data center commitments, the revenue underpinning the $27 billion in notes really, stands a chance of more or less evaporating or drying up, if you will. Advisors allocating to Blue Owl products carry indirect exposure to this single hyperscaler relationship. And so obviously there's advisor implications here, right? AI data center credit is not traditional direct lending. This is much more complex. It requires underwriting hyperscaler contract terms, right? It involves technology obsolescence timelines. It involves construction completion risk, and this goes well beyond standard credit analysis. So the takeaway here is always seek out customer concentration in any fund with infrastructure or data center exposure, and that's really what we do at Synergy Asset Management. The next two slides are really interesting because they really dive into expose why you really need to fact check everything that you see on social media. So this is another one that I pulled off of X. And the reason I use this is because I try to use examples that you all as financial advisors and asset managers would see on a daily basis. I've spent a lot of time in private credit, and at Pacific Point Advisors, we actually ran our own private credit funds. So we had to do a lot of research to basically look for alternative investments. We couldn't just recommend our own all the time. And so what you end up finding is just how, inaccurate and how out of context a lot of what you see out on social media really is. So I've got the next two slides we're going to talk about that. So this first slide talks about the Fitch default rate. The next slide, we're actually going to talk about a UBS default rate forecast, which is much higher than this 9.2% you're seeing here. But this chart circulating online cites a 6.5% bank loan default rate for 2008. And if you look at the context of this, you're kind of wondering if that's kind of the peak of the great financial crisis or what they were actually trying to illustrate here. So I'll go ahead and provide some additional context for you. The actual peak was around 11% in 2009 for the Great Financial Crisis. And the interesting part of this whole thing here is that Fitch's 9.2% default rate in private credit only covers 302 borrowers. Okay. So it's a narrow subset of private credit, not the whole market. So be critical of the context with anything that you see on social media, right? The other part of this presentation that's not accurate, and again, this I'm bringing to your attention so that when you're out looking at things on social media, you become very, very critical of what you're looking at. You be critical of the data, right? So it says that that this default rate of 9.2% is now as of March 2026. Well, it was actually for the full year 2025. And so both these numbers, this 2008 bank loan peak 6.5%, and this, March 2026 figure, these are all circulating on social media without this critical context. So people are actually taking this picture, they're copying it as their own, and using it in their own posts. Again, this came from the lead lag report, and sources were cited as Fitch Ratings, IMF, and Bloomberg. When you lift the hood and you actually go do the research on your own, you'll find that some of this information is simply not accurate. So you've got to be careful. Be advised that broader measures place the current private credit defaults at around 3 to 5%. So again, the takeaway here is regardless of the source of the data, when you're looking for information on private credit, it's all out there. When you're trying to quantify liquidity and structural risk, we ask what universe is being measured, what's the sample size, what actually defines a default. And in many cases, you actually have to, pull these reports and review them yourself, and you actually have to call the asset managers of these private credit funds to get the answers you're looking for. In this next sample, this further illustrates the importance of context, right? So just recently, UBS warned that private credit defaults could reach 15%, right? But if you actually look at the UBS report, this is an extreme tail risk scenario. But if you're looking at this following chart, and this thing is being circulated all over social media, you would never know this. You would think that, oh wow, you know, we're going to hit private credit losses that are 3 times the 2008 peak, which again, that's really not correct for the great financial crisis either. So these numbers, again, when you start looking at the 2008 peak bank loan losses, it's not that these numbers are incorrect. It's just there's a lot of different ways to measure these loan losses, and they're most likely represent a subset of loan losses. There's a lot of different ways to measure this stuff. So again, for the context, that broader measure of leveraged bank loan defaults, it did peak near 11% in 2009. But again, you'll see numbers all over the place depending upon what loan types are actually being measured. So again, the takeaway here is that when you're quantifying liquidity and structural risk, we like to confirm all data and we clarify all context by speaking with basically the private credit managers themselves. So in the next slide, we're going to look at something really, really important. And what we do is we really demand the trailing loss rates and what we call these shadow default rates. You've heard on social media and the media talk about these PIK rates or these payment in kind rates. There's also covenant waivers. So it's not just current non-accruals that we're looking for. And just be advised that the real story lags because private credit lacks daily price discovery, and deteriorating credit remains at par until formal restructuring and impairment can actually take place. So on this next slide, when we start looking at, how that 15%, tail risk could really see itself into fruition. Again, you're talking about a massive deep credit cycle really triggered by rapid AI disruption amongst data centers and software borrowers. So here's a real life example of what I was just referring to of the private credit, kind of the shadow default rate signals that advisors often miss. In this case, we're going to focus on data from publicly traded BDCs. Since they're publicly traded, this information is very readily available. You'll notice that I have the Aries and Blue Owl funds circled in red. These are some of the largest publicly traded BDCs in the United States. And you'll also see that there's PIK income, payment in kind income, above 13% above some of these, right? So we've got 15.6, 9.3, 13.8. And this basically means that borrowers are paying interest in the form of additional debt. They're not actually paying in cash, despite the non-accruals showing an impressive 1% rate. So you'll see that on each of those that I have circled, the PIK income, payment in kind, 15.5% for Ares Capital, yet they're booking the fair value of their non-accruals at only 1%. But it doesn't matter that 15.5% can't actually pay. They just take that and say, hey, don't worry about it. Make your payment next month. We'll just slap the interest and principal on the backside and we'll call it even. And then they don't book the non-accrual. So you really got to lift the hood. You really got to look into this stuff. The NAV discounts that I have circled in the very, what I guess that would be the one, two, three, four, fifth column. The 15 to 19% tell you that these public investors are already pricing in losses that the NAV hasn't recognized yet, right? So you can see the Blue Owl Technology Fund, it's at a 19.5% discount. The market's telling you something, right? Public market investors are pricing in credit losses again that the NAV is not taking into account. So the takeaway here is before you do any BDC allocation or really any private credit allocation for that matter, check those shadow default rates, the PIK rates, right? NAV discount trends, non-accrual rates, tech concentration. I mean, this is all super important. So now that we've seen some examples, let's go just a little bit deeper. The next 10 slides, we're going to examine each key risk issue mapped through our three risk lenses. Okay, so technology concentration again, we're going to split it between that and liquidity and structural risk, and then the valuation and transparency. These are 10 key risk questions that separate informed allocations from really the reactive ones. So let's go ahead and start with the first issue, and we'll just bump quickly through these. Again, you can request the deck. I'm not going to read this to you. The key point here is that on this first point is that when too many investors want out at once, gates freeze everyone's capital, right? So the typical gate is roughly 5% of NAV per quarter. Anything above that gets queued, and you're thinking, okay, well, that's fine. But the problem is that queues rolled forward, it can actually take years to clear. Not all managers have the same liquidity buffers, so we want to ask about their credit facilities and portfolio liquidity ladder. The takeaway here is that advisors need to stress test client liquidity needs against gates before allocating. I should say more or less gate provisions. They're all there. Just got to know what they are before you actually allocate. The second point here is that direct lending has become heavily concentrated in software and software as a service, right? We talked about that, and we know it's a double-edged sword. And here's how it works, right? Recurring revenue and high margins made the software companies like the ideal borrower, but now everyone is lending to them. Valuations are obviously rate sensitive, right? When multiples compress, collateral coverage ratios deteriorate fast. We like to see loans that were made post 2022, right? When rates were higher. A lot of the loans that were made prior to that, when rates were really low, as rates have risen, right? Those valuations have compressed. So keep that in mind. Also, many loans are sponsor backed, right? With 3 to 5 year maturity and maturity schedules. So if private equity exits stay frozen for long, right, the refinancing risk is real. Those 3 to 5 year maturities, they need to roll over. So we like to ask manager what percentage of their books are software and what their concentration limits are in that space. Next point is related. It's the AI infrastructure lending. The key here is that we know it's booming, but we also know that it's untested in a downturn, right? Data center financing, you got GPU-backed lending, you got hyperscaler supply chain credit. I mean, these are like all new categories of credit and credit risk. So GPU generations turn over every 18 to 24 months. It seems to be getting quicker. Asset depreciation in this area is obviously extremely fast. Many of these deals depend on contracts with just a handful of big tech companies. We've all read about that. So pay attention to that. This is a space to watch, but we don't want to avoid it. We just want to watch it. We just need to be aware of all this. Advisors need to ask about technology obsolescence risks as well as the customer concentration. So again, related to the previous slide. On this next slide, your client's private equity fund may actually be investing in private credit, right? This is pretty big, and you may not even know it. So private equity managers are increasingly allocating to credit for yield and deployment, and this is what we call style drift in asset management, and that can be problematic. Also, another phenomenon that happens, and it's called the what we call the fee on fee structures. They can layer additional costs in there that you may not even be aware of. Private equity funds invest in these affiliated credit strategies. So many private equity mandates have broad language, basically allowing credit and other quote unquote other instruments. So you've got to be aware of that. Review the offering documents carefully. If a client wanted equity upside and is getting credit yields, that's a conversation that an advisor basically needs to have with their clients. Next point is that private credit growth has just been explosive, right? It has grown 4x since 2009. We're now over 1.7 trillion. And that pace of growth, it really does create its own risks. So this growth basically filled the void after the bank retrenchment post the great financial crisis, right? So this is structural. It's not speculative, and there's nothing wrong with this. But you just have to remember that hundreds of new managers since 2015, 2016 means that there's just more competition, looser terms, everybody's competing for deals, and you've got yields that are compressed. So all the regulators, I could list them all, I won't. They're all signaling more scrutiny, and you can expect changes here ahead. But is it happening fast enough? That's what we have to ask ourselves. So we need to be the ones, really being and scrutinizing this. We really need to be aware of this. So the takeaway here is that growth is good, but you need to ask whether the manager that's being evaluated was around before the flood of capital arrived, right? What's their experience? There's obviously risk here. On this next slide, the key point here is that you can't compare private credit returns apples to apples against different fund structures. Earlier we talked about that grid. This really adds to the complexity. When you actually start looking at these funds, you're going to find just different methods of reporting yields. Closed-end funds report internal rate of return and total value to paid in capital. Open-ended and BDCs report NAV-based returns. These are totally different metrics that advisors need to understand. And again, the yield reporting varies. I mean, I've got a lot of personal stories I could share with you on this, but this whole concept of gross versus net, it's real. Is whether PIK income is being included or excluded, and if your dividends also include the return of capital, right? Traditionally, dividends are return on capital, but in many cases, those can be kind of depleting. They can actually be returning your capital at the same time. So you gotta need to be aware of that. Private funds mark to market less frequently, with much more discretion. The net effect of this is that it actually smooths returns and hides real volatility. And we see this when we do bake-offs with, high net worth, ultra high net worth clients that hold private equity investments. They think, oh, I'm safe. The standard deviation's so low. It's this, it's that. Well, it's because they're just not being marked to market alongside their stocks, which actually trade daily and have daily mark to market. So just keep that in mind. So when a client asks, what's the return? This is the takeaway. You really have to roll up your sleeves and dig in to how it's actually being measured before answering. And again, in many cases, we end up having to call the fund manager to discuss the returns. In many cases, we have difficulty making sense of the numbers, even with our experience. Next slide, key point is here, not all private credit funds play by the same rules, right? Investor protections vary enormously, right? So BDCs, obviously the most regulated, they're registered under the 1940 Act, have leverage limits, quarterly disclosures, broad oversight. These private funds, they are largely self-regulated, right? We went through that in the grid. Disclosure is primarily limited to the limited partnership agreements. And then if you're looking at private credit funds with like offshore structures, out of the Caymans or Luxembourg or anywhere else. Those add jurisdictional complexity, reporting complexities, and obviously will add additional risks. So you need to know what structure your client is in. It really does determine what protections they actually have. The next slide, private equity and private credit investors are often the same people. And this really can amplify that contagion risk, or at least the speed of contagion, if you will. And the reason for that is like when private equity headlines turn negative, the same private equity limited partnerships may panic redeem their credit, right? From credit, if you will. Even if the credit quality is fine, right? They need liquidity. They basically panic sell. Everybody does this. It's just a normal behavioral finance aspect. Everybody always wants out the exit door at the same time, it seems, right? So the key takeaway here for advisors is that you do have the capacity to serve as the firewall here. So proactive communication and knowledge of these structures and these investments will prevent the sentiment-driven mistakes that others often make. Next point, next slide here. We've seen a lot of this lately, super critical, and today more critical than was even 6 months ago. These geopolitical shocks. They don't just affect equities, right? They pressure private credit through many channels. Energy price spikes, right? They increase input costs and increase borrower stress across virtually all sectors. Sanctions that tighten credit availability through associated banking networks. Public credit sell-offs, they have a tendency to widen spreads. We see this all the time, eventually forced markdowns on private credit too. And again, we've seen that recently. The takeaway here is that the private credit is not immune to macro events. The transmission, again, it's just slower and less visible, and we've talked about that. So just be aware of that. And the last point here is that how private credit gets valued is just as important as how it performs. Internal valuation committees, right? They generally mark to market loans quarterly. The key here, as I said, internal valuation committees. There can definitely be a conflict of interest there, right? Manager discretion can create upward bias. Be aware of that. Third-party valuation firms can help, but independence and engagement terms vary. So you need to figure, we'll need to figure that out, what that looks like. Keep in mind again that quarterly mark-to-market valuations with that discretion, it does have a tendency to smooth volatility out, right? So it gives the appearance when you're baking off these investments against other alternatives, it gives the appearance that private credit looks less risky than it may really be. So just be advised of that when you see, really low standard deviation numbers when you're looking at risk in these private credit investments. You've got to ask the right questions. Ask the managers, who values the portfolio, how often, whether the valuer is hired by the general partner entity of the fund or if there's an independent board, if it's internal. Just have to be aware of how these assets, these underlying assets, are being actually valued. In closing, private credit remains compelling for qualified investors seeking income and diversification, right? That's our perspective. The considerations we've discussed today are not reasons to avoid the asset classes, but they're reasons to simply be informed. The advisor who understands these nuances will obviously serve their clients best. If you would like a copy of today's presentation, or if you have questions about private credit or how you or your firm can work with Synergy Asset Management, please don't hesitate to reach out. We're here to help. Feel free to follow up via phone or email, and be sure to follow us on LinkedIn. Remember, we're a resource, not just a presenter. Thank you for your continued support of Synergy Asset Management, and we'll see you next time.